Welcome to our deep dive today. We've got a really interesting topic, actually. It might not seem that way at first, but a bunch of you sent in material about how corporations manage their finances.
Yeah, it can seem a little dry.
Right. Like, how exciting can that be?
Well, I'll tell you, once you get into it, it's fascinating.
Yeah?
It's like peeking behind the curtain and seeing how decisions get made. You know, all the stuff that makes businesses actually work and grow.
That's a great way to put it.
And sometimes, of course, fail. You know, it's all in there.
Oh, for sure. So, expert speaker, since you spend all day thinking about this, what's the thing that would surprise people the most about how companies manage their money?
You know, most people think it's all about the here and now, like crunching numbers and making sure the bills get paid. But it's really about the future. It's about making smart choices today that will affect a company years down the line.
Really? So, like predicting what's going to happen?
It's more than that. It's about making choices that set the company up for success no matter what the future holds.
That's pretty impressive. So where do they even begin? I mean, if a company is thinking about, managing its finances, what's the first step?
Well, they start with a plan. A financial plan,
Yeah.
It lays out their goals, their strategies, how they are going to use their resources. It's basically a roadmap for financial success.
So is it like a giant version of my monthly budget?
Kind of.
Like instead of deciding between pizza or, paying my electric bill, they're dealing with millions of dollars, maybe even billions.
Exactly. But yeah, the stakes are a lot higher.
Yeah, I bet. I mean, if I mess up my budget, I might have to skip a vacation. But if a corporation messes up...
Well, you could be talking bankruptcy.
Wow.
Job losses, yeah. It's a big deal.
So they probably have entire teams of people just focused on getting that plan right.
Oh, yeah. They have whole departments, sophisticated software, the whole 9 yards.
Wow, that's pretty intense. So once they have this plan, how do they actually make the money to, make it happen?
That's where revenue generation comes in.
Right, bringing in the cash.
Yeah.
So is it just about selling as much as possible?
Well, that's part of it, but it's more nuanced than that. Think about diversification. You hear that term a lot, right? It might seem like they're spreading themselves too thin.
Yeah.
But look at a company like Amazon. They started with just books. Now they sell, everything. That's diversification, and it's one of the reasons they're so successful.
So they don't have all their eggs in one basket.
Exactly. If one area of their business takes a hit, they have others to fall back on.
That's a good strategy. It's like investing in the stock market. You don't want to put all your money into just one stock.
Right. It's about managing risk.
Okay, I'm getting it.
Mm.
But even if a company's bringing in tons of revenue, it won't mean much if they can't manage their costs, right?
You're hitting on a crucial point there. Managing costs is absolutely essential for any corporation, no matter how big or small.
It's something I struggle with personally.
Well, it's the same idea, just on a much larger scale. For corporations, it's not just about cutting costs, though. It's about understanding their cost structure.
Their cost structure.
Yeah, knowing what costs are fixed, what are variable.
Okay.
And finding ways to be more efficient. Even small improvements can have a huge impact.
So, like how I try to find cheaper alternatives for the things I need.
Yeah.
Or maybe cutting back on those streaming subscriptions I don't actually use.
Exactly, except they're doing it with things like, raw materials or shipping costs.
So even saving a little bit here and there can add up to big savings overall.
Oh, yeah, absolutely. Take a company like FedEx, for instance. If they can optimize their delivery routes, even by a few miles per truck, think about the fuel costs they'd save over a year.
That's amazing. And that reminds me of another thing that needs to keep flowing, right? Cash flow.
You got it. Cash flow is like the lifeblood of a business. It's the constant movement of money coming in and going out. And if that flow gets disrupted, even a profitable company can be in serious trouble.
So even if they're making money on paper, if the cash isn't coming in steadily, they could still run into problems.
Absolutely. It's like having a clogged pipe. Even if there's plenty of water in the tank, if it can't get through, you're going to have a problem.
That's a great analogy. So how do companies make sure their cash keeps flowing smoothly?
They track it very carefully, of course. They forecast their cash flow.
Forecast. So they try to predict the future.
Well, yeah, they try to predict periods where cash might be tight, and then they can prepare, make sure they have enough on hand to cover their expenses, even if something unexpected happens.
But what about those things you can't predict, like a sudden recession or I don't know, a global pandemic.
Well, that's where having a really solid financial plan comes in.
Yeah.
And strategies like building up cash reserves, having a rainy day fund, and diversifying their income streams.
Okay, spreading the risk. It seems like that's a key theme here.
It is. And some companies even use tactics like hedging, which is basically making strategic investments to protect themselves against specific risks, like price fluctuations in raw materials, for instance.
So they're always thinking a few steps ahead, huh?
That's the name of the game.
Wow, I'm starting to get a whole new appreciation for what goes into running a successful business. So they've got their plan, they're bringing in revenue, managing their costs, making sure the cash keeps flowing. But what happens when they need a big chunk of money all at once? Like if they want to expand their operations or invest in a new product.
That's where corporate financing comes in. And that's a whole other fascinating world. We're talking about things like debt financing and equity financing.
Okay, debt financing sounds familiar. Is that just like taking out a loan?
Yeah, essentially. It could be anything from a traditional bank loan to issuing bonds. They get the money they need but have to pay it back with interest.
Okay. And what about equity financing? That sounds more complicated.
Well, with equity financing, they're essentially selling a piece of the company to investors in exchange for their capital.
So it's like instead of borrowing money, they're bringing in partners.
Exactly.
So debt financing is like taking out a mortgage to buy a house. And equity financing is kind of like, I don't know, crowdfunding.
You got it.
That's something a lot of our listeners are probably familiar with.
Yeah. And each option has its pros and cons. Debt can be a good option if a company has a solid credit rating and can get favorable interest rates.
Right.
But it does increase their financial obligations.
Yeah, you have to pay that money back.
Exactly. With equity financing, on the other hand, they don't have to make those regular payments. But they do give up some ownership in the company.
So it's a trade-off.
It is.
Ah.
And it really depends on the company's specific needs and goals.
That makes sense. So once they have that money, how do they decide where to put it to work for future growth? I mean, what are some of the avenues they explore?
Well, there are capital expenditures where they invest in tangible assets, things you can actually touch.
So like buying new equipment, building a new factory.
Exactly. Or upgrading their technology, things that can help them boost their efficiency, produce more products, or expand into new markets.
Okay, so it's about investing for the future.
Right. And then there's research and development, or R&D, as it's often called.
Oh, R&D. That's where all the cool stuff happens.
Yeah.
Coming up with those amazing new products like new features for smartphones or cures for diseases.
That's the heart of innovation. And companies that are serious about staying ahead of the curve, they invest heavily in R&D. Companies like, Tesla, Apple, they're constantly pushing the boundaries of what's possible.
That's so cool. And it seems like those investments often pay off big time.
They can, but there's another way that companies can invest for growth, and that's through mergers and acquisitions.
Ah, so like when one company buys another company?
Exactly. It can be a big deal for both companies involved.
Yeah, I remember when Disney bought Pixar.
Exactly. Or Facebook buying Instagram. Those are huge moves.
It seems like those kinds of deals could be pretty risky though, right?
They can be, but they also have the potential for huge rewards. It could be about gaining access to new technology or expanding into new markets or even eliminating a competitor.
So it's like a high-stakes game of chess.
And that's a great way to put it.
Wow. It's fascinating to see how corporations use investments to reshape their future. But with all this talk about making money and investing for growth, how do we know if a company is actually successful? Is it all about profit?
Profit is definitely important. It's a key indicator of financial health. But it's not the whole story. Corporations use a variety of financial metrics to analyze their profitability and their overall performance.
Metrics, so like specific ways of measuring their success.
Exactly. And one of the key metrics is the gross profit margin.
Gross profit margin, what's that?
Well, basically, it tells you how much profit they're making on each dollar of sales, after accounting for the direct costs of production, that is.
So it's like, if a company sells a product for $10, but it costs them $5 to make it, their gross profit margin would be 50%.
You got it.
Okay, that makes sense.
A healthy gross profit margin shows that a company is pricing its products well.
Right.
And managing its production costs effectively.
Okay, so what other metrics are important?
Well, then there's the net profit margin.
Net profit margin. What's the difference?
Well, the net profit margin takes all expenses into account. Not just the direct cost of making the product, but operating expenses. Things like marketing, salaries, rent,
Ah, yeah.
taxes, interest payments, the whole nine yards.
So it's like the bottom line.
Exactly. It's a crucial indicator of overall profitability and efficiency.
So the gross profit margin tells you how much profit they make from each sale, and the net profit margin tells you how much they actually keep after paying all the bills.
You got it.
Okay, that's starting to make sense. But are there any other important metrics?
Oh, there are tons. But one more that's really important is the return on investment.
Return on investment.
Or ROI for short.
Okay.
And it's basically a way to measure how effectively they're using their investments to generate profit.
So are they getting a good return on the money they're putting in?
Exactly. And they use this to evaluate everything from their marketing campaigns to their, big capital expenditure projects.
Okay, so it's like when we invest our money in our 401ks, we want to make sure we're getting a good return.
Precisely.
It's all starting to come together now. It's a lot more strategic than I realized.
Oh, yeah, there's a lot more to it than meets the eye.
So we've talked about how corporations make money, how they manage their costs, how they make investment decisions. But with all this money floating around, how do we know they're playing by the rules? I mean, we hear about corporate scandals all the time.
That's a great question, and it's where corporate governance and compliance come in. Think of it as a system of checks and balances.
Checks and balances, okay.
That's designed to keep corporations accountable. And a key player in this system is the board of directors.
Okay, the board of directors.
Right. They oversee the company's financial decisions and make sure the company's management is acting in the best interests of the shareholders.
So they're kind of like the referees, making sure everyone's playing fair.
That's a good way to put it.
And are there specific rules that corporations have to follow?
Oh, yeah. There are all sorts of regulations, from financial reporting standards to tax laws, environmental regulations. The list goes on and on.
So it's not just about making a profit. It's about doing it ethically and responsibly.
Exactly.
And those regulations help to ensure transparency, right?
That's a big part of it. Transparency so that investors and the public can have confidence in the financial information that's being reported.
Okay, that makes sense. But even with all these safeguards in place, isn't there always some level of risk involved in running a business?
Oh, absolutely. Risk is unavoidable. It's just part of the deal.
So no matter how well managed a company is, there's always a chance that things could go wrong.
That's right. And those risks come in all shapes and sizes. You have market risks.
Market risks.
Like fluctuations in demand or changes in commodity prices, things a company can't really control.
Okay, that makes sense.
And then you have credit risks.
Credit risks. What are those?
That's the risk that customers or borrowers might not pay their debts. If a company extends credit to a customer and that customer goes bankrupt.
Oh, wow, that could be a big problem.
It could. And then you have operational risks.
Operational risks. What are those?
Those are risks that can arise from a company's own internal processes or systems.
Okay.
Maybe a system failure or an accident at a factory.
Right. So even if the economy is doing well, things can still go wrong within the company itself.
Exactly. Or even external events, natural disasters, political instability, things like that.
So basically, there's a whole lot that can go wrong, even for the most well-managed companies.
That's the reality of the business world. But it's not all doom and gloom.
Right.
I mean, corporations have developed sophisticated ways of managing these risks.
So they're identifying potential risks, assessing their potential impact, and putting plans in place to deal with them.
Exactly. And it all starts with understanding what those risks are.
Okay, that makes sense. So what are some of the strategies they use to mitigate those risks?
Well, one obvious one is insurance, right? Just like you buy insurance for your car or your home.
Right.
Companies buy insurance to protect themselves from financial losses.
Okay.
But they also use more complex strategies like hedging.
Hedging. That sounds complicated.
Well, it can be. But essentially, it involves making strategic investments to offset potential losses from specific risks. Like if a company is worried about the price of a certain commodity going up, they might make an investment that would pay off if that happened.
So it's like a safety net.
Exactly.
Interesting. And of course, we've already talked about diversification, which seems like a key strategy for managing risk.
Absolutely. It's all about not putting all your eggs in one basket. Whether it's your investments, your product line, or your supply chain, spreading the risk is always a smart move.
Okay, that makes sense. But how can we, as outsiders, really get a clear picture of a corporation's financial health? I mean, We can't just call them up and ask for their bank statements, right?
Well, that's where financial reporting comes in. Corporations are required to publish detailed financial statements that provide a comprehensive view of their financial standing.
Oh, okay. So those are the reports we sometimes hear about in the news, like income statements and balance sheets and cash flow statements.
You got it. And those statements are packed with information. They tell you about the company's revenue, their expenses, their assets, their liabilities, their cash flow, you name it.
Wow. So it's all right there out in the open.
It is. And to ensure the accuracy and integrity of that information, they have to undergo external audits.
Audits. So someone else checks their work to make sure it's all legit.
Exactly. Independent accounting firms come in and review their financial statements, make sure everything is on the up and up.
So it's kind of like a financial checkup.
That's a great way to put it. And those audits are essential for building trust and confidence in the financial markets.
It makes sense. I mean, if I was going to invest in a company, I'd want to know that their numbers were accurate.
Exactly.
Wow, this has been incredibly insightful. I never realized how much goes into managing a corporation's finances. It's a lot more strategic and nuanced than I ever imagined.
It's a fascinating world, that's for sure.
Well, we've only just scratched the surface.
We have. There's so much more to explore.
This is amazing. We've covered so much ground already. And to think, we're just getting started.
We are. We've got lots more to talk about.
Well, listeners, you won't want to miss part 2 of our deep dive, where we'll go even deeper into this fascinating world of corporate finance. We'll be back soon. Welcome back to our deep dive into the fascinating world of corporate finance. You know, I gotta say, I'm really enjoying this. It's way more interesting than I thought it would be.
I told you.
It's like we're getting this behind-the-scenes look at how businesses actually work.
It is pretty cool when you start to understand all the moving parts.
Yeah. So before the break, we were talking about financial reporting and how important transparency is. But let's be honest, those financial statements can be pretty intimidating.
Oh, yeah.
All those numbers and technical terms. How do people actually make sense of all that?
That's where financial analysis comes in.
Okay, financial analysis.
Yeah.
So it's like taking those raw numbers and turning them into something understandable.
Yeah. It's about extracting meaningful insights from those reports. You know, it's like deciphering a code that reveals a company's true financial health and performance.
So like being a financial detective.
Exactly.
What kind of clues are they looking for? What are the red flags that might signal trouble?
Well, one of the first things they look at is profitability. You know, is the company actually making money?
Right.
And are those profits growing over time?
Okay, so that makes sense. What else?
They also look at liquidity.
Liquidity, what does that mean?
Basically, does the company have enough cash on hand to meet its short-term obligations? You know, pay its bills.
Ah, okay, so do they have enough cash in their pocket to cover what they owe right now?
Exactly. And then, of course, they examine solvency.
Solvency.
Which is the company's ability to meet its long-term debt obligations. So can they pay back their loans?
So it was like a financial health checkup, right?
That's a great way to put it.
Are they making money? Do they have enough cash to cover what they owe in the short term? And can they pay back their debts in the long term?
You got it. And any weakness in those areas can be a real cause for concern.
So give me an example. What kind of red flag would make you worried about a company?
Well, if a company's profits are declining, that could be a sign that they're losing market share or facing tougher competition.
Okay, so their business isn't doing as well as it used to.
Right. Or if their liquidity is low, that could signal they're struggling to manage their cash flow effectively. You know, like we were talking about before.
Right, if that cash flow gets clogged up, things can go south pretty quickly.
Exactly. And if their debt-to-equity ratio is high, that could raise questions about their long-term sustainability.
Debt-to-equity ratio. Okay, I'm going to need you to break that one down for me.
Sure. It's basically a measure of how much debt a company is using to finance its assets relative to the amount of equity it has.
Okay, so a high debt-to-equity ratio means they're using a lot of borrowed money to run their business.
Right. And while some debt can be healthy, too much debt can put a company at risk. You know, if interest rates rise or if their earnings take a hit, they might struggle to make those debt payments.
Right. It's like if I take out too many loans, I might not be able to keep up with the payments if something unexpected happens.
Exactly.
So this is all really interesting, but how can everyday investors like me use this information to make better decisions about where to put our money? I mean, it's hard to know where to even start.
You're right. It can seem overwhelming. But even without a degree in finance, there are things you can look for. First and foremost, do your research.
Research, okay.
Don't just jump on the latest investment trend or take someone's word for it. Take some time to actually read a company's financial statements, even if you just focus on the highlights. Look for trends. Are their profits growing steadily? Are they managing their debt well?
Okay, so it's about being informed and not just following the hype.
Exactly. Dig a little deeper and try to understand the company's business model. Who are their competitors? What are their future prospects? Read industry reports. Check out what analysts are saying. And stay up to date on news and events that could affect the company's performance.
That makes sense.
Mm.
So research is key. What else should we keep in mind when we're evaluating a company?
Another important factor is management quality. Who's running the show? Are they experienced? Ethical? Do they have a good track record of success? A strong management team can make a huge difference in a company's performance.
Right. It's not just about the numbers. It's about the people at the helm.
Exactly. And finally, don't underestimate the importance of diversification. We talked about this a little earlier, but it's really a golden rule of investing. Don't put all your eggs in one basket. Spread your investments across different industries, asset classes, geographic regions. That way, you can reduce your overall risk.
Diversification, right.
Yeah.
It seems like that's a recurring theme in corporate finance and a smart strategy for investors as well.
Yeah.
But let's zoom out a bit now. How do these concepts play out in the bigger picture of the economy as a whole? I mean, what are some of the forces that can affect a company's financial success, even if they're doing everything right internally?
That brings us to macroeconomics.
Macroeconomics, okay.
Right. These are those broad economic forces that can impact businesses and financial markets as a whole.
So we're talking about things like, interest rates, inflation, economic growth.
Exactly. Those are all part of this bigger picture.
Okay, so those are the things we hear about on the news all the time. But how do they actually impact corporations on a practical level? I mean, can you give me an example?
Sure. Like, let's say interest rates go up. That makes it more expensive for companies to borrow money, right?
Right. Just like it's more expensive for me to get a mortgage when interest rates are high.
Exactly. And that can make companies less likely to invest and expand.
Okay, so higher interest rates can put a damper on economic growth.
They can. And then you have inflation, which everyone's been talking about lately.
Yeah, prices are going up everywhere.
That can really eat into corporate earnings. I mean, if a company's costs are going up, but they can't raise prices, their profits are going to shrink.
Right. It's got to be tough to plan for the future when you don't know what's going to happen with inflation.
It is. And it can be a real challenge for companies to balance these external pressures with their internal goals.
It's amazing how much complexity there is in the world of business and finance.
It's a lot to keep track of.
It is. It's like this giant puzzle with all these interconnected pieces influencing each other.
That's a great way to think about it.
So we've covered a lot of ground here today, from financial statements to macroeconomic trends. But before we wrap up, I want to shift gears a bit. When we come back, we'll be diving into the ethical considerations of corporate finance.
That's an important one.
It is. We've talked about how corporations make money and how they manage their finances. But what about the responsibility that comes with that power?
Stay tuned.
We'll be right back. Welcome back to our deep dive. We've covered a lot of ground in this episode. Everything from financial planning to risk management, investment strategies, those big macroeconomic trends.
It's been quite a journey.
It has. But now it feels like we're moving into a different realm, something that's not just about numbers and strategies.
Right. We've explored the what and the how of corporate finance.
Oh, exactly.
Now we're getting to the why, the values and the responsibilities behind it all.
Okay, that's where it gets really interesting. We've talked about how corporations make money, how they grow, all that. But what about the ethical side of things? What does it actually mean to talk about responsible corporate finance?
Well, it's recognizing that financial decisions have consequences. Consequences that go way beyond just the bottom line. It's about considering all stakeholders.
All stakeholders. So not just the shareholders.
Right. We're talking about employees, customers, suppliers, the communities where a company operates, even the environment.
Wow.
Responsible corporate finance means understanding that a company's success is tied to the well-being of all these stakeholders. It's about making choices that are sustainable, ethical, not just profitable in the short term.
I see. So it's about the long game, thinking about the impact of their decisions on everyone involved.
Exactly.
It makes me think about all those news stories we see about companies, cutting corners, polluting the environment, exploiting workers overseas. It seems like there's a growing awareness that businesses need to do better.
There is. And it's coming from all sides. Consumers are more conscious about where they're spending their money. Investors are looking at ESG factors, environmental, social, and governance. And employees want to work for companies that align with their values.
ESG, right? We hear that term a lot these days. So it's not just about doing the right thing, it's becoming good business practice.
Exactly. Companies that embrace responsible corporate finance, they're more likely to attract top talent, build strong relationships with their customers, and really boost their reputation.
That makes a lot of sense. So can you give us some specific examples of what this looks like in practice?
Sure. One big example is sustainable investing. That's where investors are putting their money into companies that are committed to things like environmental sustainability, social justice, good corporate governance. It's using investments to create positive change.
So it's like they're not just chasing the highest returns, they're choosing companies that are trying to make a real difference in the world.
Right. And this is really gaining momentum. Investors are realizing that they can align their portfolios with their values without sacrificing returns.
That's pretty amazing. What other examples come to mind?
Well, there's corporate social responsibility, or CSR.
CSR, right.
This covers a lot of different initiatives, like reducing their carbon footprint, supporting their local communities, promoting diversity and inclusion in the workplace. It's going above and beyond just complying with regulations.
So it's about being proactive and finding ways to actively contribute to a better society.
Exactly. And a lot of companies are finding that these CSR initiatives are actually good for business, too. It can really enhance their brand, boost employee morale, even drive innovation.
Okay, so it's a win-win.
It can be.
But let's be real for a minute. Do you think all corporations are really on board with all this? Or is some of it just for show?
That's a fair question. And it's important to be critical. There's definitely a range when it comes to how committed companies are to these principles. Some are leading the way. Others are, well, they're still catching up.
So how can we, as consumers and investors, tell the difference? How can we hold corporations accountable and make sure they're actually walking the walk?
Transparency and accountability are key. Look for companies that are open about their practices, publish sustainability reports, and look for those that are engaging in meaningful dialogue with their stakeholders, and support organizations that are pushing for stronger corporate governance and ethical business practices.
Okay, so do your research, look for transparency, support organizations that are advocating for change.
Yeah.
And as consumers, I guess we can vote with our wallets, right?
Yeah.
Choosing to support businesses that are aligned with our values.
Exactly. Consumer pressure is a huge driver of change. By supporting companies that are doing the right things, we send a powerful message to the market and encourage others to follow suit.
This has been an incredible deep dive. I've really gone deep, haven't we? From the nitty-gritty of financial statements to this bigger picture of the impact of corporate decisions on the world. And it's clear that corporate finance isn't just about numbers, it's about people.
It is. It's about values. It's about building the kind of world we want to live in.
It's about recognizing that financial decisions have ripple effects, that they can touch so many lives, and about using the power of business to make a real positive impact.
Couldn't have said it better myself.
So, listener, as you go about your day, pay attention to the financial decisions being made around you. Ask questions, demand transparency, and make choices that align with your values. We all have a role to play in shaping a more responsible and sustainable financial system. Thanks for joining us on this deep dive.